Okay, let's talk the 10 network today, reporting a steep net loss of more than $260 million in H1 after writing down the value of its TV licence. The performance has also been dented by weak ad sales and a bad run of ratings for much of its on-air lineup. The company flagging that it may need to tap capital markets for more funds. The results, though not as bad as many were expecting. Forecasts for the net loss were as high as $317 million. There is, though, no interim dividend being paid. So look at the shares, if we can, in 10. Well, what can you read from that? That they are currently up about 1.25%, but they've been bobbing around. Down and up, every which way. What does Chris Conway from the Australian Stock Report think of it all? He's live in our Melbourne studio. Chris, let's stay on that story. Your thoughts and what it takes to move these shares in particular. We shouldn't read too much, I guess, given the nature of the register.
Yeah, look, in terms of the 10 results, Carson, as you stated in the lead-up, the numbers weren't as bad as expected. I don't think it will give a lot of confidence to investors, though. The reason for that is obviously the ad revenue, which remains stagnant, and a bit of a broader theme here. Ad revenues across the entire media space have been pretty stagnant, but there's been a massive growth in online spend. And that's a symptom of consumers changing their preferences. So, you know, everyone's busy these days. They don't necessarily want to sit down at 7:30 at night and watch a half-hour program with 10 hours of ads. They'd rather pay for their content and be able to watch it on any device that they like. So I think the broader theme there is that the entire media, TV media segment is struggling. Again, the numbers today from 10, not as bad as expected, but I don't think a long-term catalyst to drive the share price higher.
Would you be buyer, holder or seller of this when they say that they may not survive an unexpected fall in advertising? It's not a rhetorical question, but it might as well be.
Yeah, no, we definitely wouldn't be buyers, again, on the long term. Look, it might come down to whether or not they get that deal across the line with Foxtel, the latest incarnation of the long and tortured sales process that 10 has had to endure, sees Foxtel potentially taking a 14.9% stake, pumping in around $85 million and potentially tapping investors for another $100 million. Of course, that'll be the third time in 3 years that they've done that. So as a trader, you might buy it, hoping that the deal gets across the line, but again, as an investor, we don't see it.
And you believe that Foxtel, certainly the Telstra division of it, would be quite happy to preside over sporting rights potentially flowing out their door and into 10s if this happened?
Not necessarily, no, good question. Maybe they wouldn't be happy with that. Again, it'd be interesting to see what the synergies would be. Obviously, they think there's some value in the deal, but look, it remains to be seen whether that will happen. As I said, we've seen so many deals there fall over. We've seen interference from Bruce Gordon, one of the major shareholders, who's basically said that he won't sell under any circumstances. Of course, he has a 15% stake. So I think to get a deal across the line, you need 90.1%. So if he's unwilling to sell, it's simply not going to happen. So, yeah, still a very troubled outlook for 10, not something that we would be buying. Again, look, as a trader, if you were thinking that the deal would get across the line, you might take a short-term position, hoping that you do get that event that would cause a material increase in the share price. But that is a big if, a big if.
Let's move on and let's look at the recent sort of commodity price moves. No sooner do we get even Santos today talking about these lows having passed in energy, we get another leg down in iron ore. So it's very difficult to draw hard and fast conclusions from any of this.
Yeah, look, last night was a very pertinent reminder that the recovery in commodity prices is going to be extremely lumpy. Investors or traders as well might have been a little bit complacent recently with the iron ore price rising around 20% over the last month. It seemed as though the game was back on, and like I said last night, a pertinent reminder that it will be volatile and will be lumpy. That's something that we've been telling our clients. So if you are going to play in that space, you need to be aware of the risks. Longer term, in terms of the iron ore market, there is a case for some higher prices over time, and that's because we're expected to see around 160 million tonnes per annum of iron ore production move out of the market this year. That's as some of the marginal producers go to the wall. And of course we saw, I think it was last week, BHP saying that they're not going to ramp up their production as quickly as they had previously stated. So there's certainly some supply side dynamics that are changing that could sustain higher prices over the longer term, but we're not going to see the meteoric rises that we've seen in the last month. And again, last night, a really good reminder of that fact.
And the kind of whipsaw moves in FMG, how do you trade those?
Again, I guess you just look at the iron ore price in the morning, and if it's up, you buy it, and if it's down, you sell it. I don't think it needs to be any more cerebral than that. Again, good trading opportunities for those active traders out there. They will probably be loving the volatility. The longer-term investment case, like I said, some supply-side dynamics changing, which makes them interesting. But what I've always said is it's about consistent commodity price increases, and I just don't think that we're going to get that in the foreseeable future.
Chris, thanks as always. Appreciate it. Chris Conway.
Thanks, Carson.
From the Australian Stock Report, live in our Melbourne studio.